Market news now. Asian shares deepened losses on Tuesday amid a fresh deterioration in the Sino-US tariff trade war. Although comments from US President Donald Trump that he expected trade negotiations to be successful helped stabilize sentiment, China on Monday announced that it would impose higher tariffs on $60 billion worth of US goods following Washington's decision last week to hike its own levies on $200 billion in Chinese imports. It's read across the board in Asia, with the Japanese Nikkei just over 0.5%. The Shanghai Composite followed the mark, closing 0.2% weaker, while the biggest faller today was the Hang Seng in Hong Kong, which lost 1.4%. Wall Street shares sank on Monday after China defied Washington by announcing retaliatory tariffs, the latest salvo in the two countries' increasingly belligerent trade dispute, sending investors fleeing equities for less risky assets. The Dow Jones Industrial Average fell a massive 2.38% to 25,324 points. The S&P 500 was volleyed 2.4% into the red, while the Nasdaq Composite was hammered 3.4% to 7,647 points. Now, for more on the markets, we cross over to Arabile Gumede, who is at the Johannesburg Stock Exchange. Very good afternoon to you, Arabile. Looks like quite a mixed picture behind you on the board.
Yeah, it is fairly mixed, I suppose, when you take a look at just the indices, the stocks themselves, should I say. But when you take a look at the overall picture, it is fairly positive. And one wonders exactly where this comes from. There's a negative sentiment flowing across the market, as you said a little bit earlier on. China retaliating with that tariff increase as well, on $60 billion worth of US goods. And a lot of those goods are based on soybeans. Of course, soybeans are the most valuable sort of export out of the United States to the likes of China. 2018 saw them fall with regards to their exports to their lowest ever in 2018, and the exports to the rest of the world couldn't make up for that. So it certainly is a dire picture there, not just for farmers in the United States, that where Donald Trump has now said he'd probably give them around $15 billion in terms of aid to help that scenario, but it is one where the market itself has sort of said, where to from here and where does it end? They are meeting again at the end of June at the G20 summit, according to President Donald Trump. So that picture will hopefully come a little clearer from there. It has sent negativity and rattled the markets across the globe. But for now, let's see exactly how things are faring, and we'll unpack it in just a bit. So the market goes up here locally, but China going down, the United States, all the indices there falling more than 2%. What exactly has happened, and why is South Africa not following, I suppose, the same sentiment? Martin Harris joins us this afternoon. He's from IG South Africa. Martin, thank you so much for the time, but it's a bit of a weird picture though, isn't it? Is it one that we can really explain? Is the market just saying, well, the US doesn't matter to us, or the China trade deal situation doesn't matter to us? What exactly is going on here?
Thank you for having me, Arabile. I think definitely if we take a look at things, Asian markets down. This is the first opportunity that they've had to react to the news from China yesterday. We saw that news affect the US markets, European markets and South African market yesterday. And so today, a bit of a recovery, a more resilient market. I think there is a perception that between China and US there might be an agreement reached. China have a considerably resilient political space, and so they can take this deal and protract it out for a much longer time than the US can. So there's a perception that the US has a weaker hand and are more desperate for the deal.
Yeah. And words of a recession then have also begun filtering through into that US economy. Is it that vulnerable?
The US economy, I've been actually quite surprised at how resilient they have been towards these China trade war issues. Yeah. And so I think that they are far more buoyant than we expect, simply because the market continues to be resilient whilst people are nervous about it. When everyone is too excited about the market, that's normally when things start turning. So people are still cautious, the market's still going up, and I think from the perspective of the US Fed, they're doing everything in their power. They're talking very dovishly now to ensure that this market remains buoyant and continues to go up.
If it does go down, this doesn't send the right sort of message for Donald Trump towards the end of his presidency, does it though? You'd have a recession in his time period. The markets would have certainly not loved this one. Farmers and households would not have gained from this trade war in itself. It certainly is beginning to look a little more negative, and the upper hand we thought Donald Trump has here isn't necessarily the case.
That's right. I think, Trump's administration and Donald Trump have been sort of trying to poise themselves as economically a safe bet. They're really good for markets. They're great for wealthy individuals. They're great for business. And so for this to happen, also before Trump gets potentially re-elected, would be a disaster for his campaign. And so we might not see 2 terms of Donald Trump if this happens in the short term. So a lot of this play with China, I think, is to extend Donald Trump's tenure as president. And so in terms of the risk that they face now with the farmers, Donald Trump's political base has come through the Midwest and farmers and the blue-collar workers. And so he needs to keep them satisfied and essentially pay them money, whilst Chinese government, they've got a as we said, much more obedient sort of civil society who will comply with the pain that China now actually has to take from the tariffs imposed on them by the United States.
Yeah, it's going to hurt the US by the seams of things, and the tide may certainly be turning in this conversation. Hopefully, they find a resolution by June, though, because we have been talking about this for quite a long time, almost now as long as Brexit. But nonetheless, that's a discussion for another day as we reach an end to that. Let's talk about South Africa then. We come back here locally. Yes, we've had the elections, a positive end to it in some ways, that we do have a clear government and President Cyril Ramaphosa still leading the country. But then, now you see the state of how bad things really are in South Africa. 27.6%. A bit of a worry?
It is a concern, and I think the biggest concern about the current unemployment rate is that there's no indicators that things are set to change.
Yeah.
When you've got stalling investment and stalling growth due to lack of certainty around power output, there's no money coming into the country, there's no new developments because people are concerned that there's not enough power to actually generate new production, can't have new facilities running on anything. So until there's a political certainty around what is the outcome on the state-owned enterprises, what is the political outcome on labor unrest, I don't think we're going to see a change. So certainly not looking good for the next year, 2 years.
Yeah, it's a worry then, because the promise then has always been for not just better jobs, but a better economy on the whole. We had a whole investment drive in 2018 and even a job summit, and one where they said they'd have to create a certain number of jobs. We've got the Yes campaign as well. All of those things not culminating in the answers we're looking for. How dire is the situation, and how much more is the country going to hold the president to account here?
So the situation is difficult. So we've got also these 2 streams of the South African economy. We've got the informal sector and you've got the formal sector.
Yeah.
Informal sector is in its own right booming, and there's a lot of cash that flows through there, but the scalability, there's problems, people can't really take a sustainable income out of it, whilst the formal sector is retreating. And so the situation where I think both private and public enterprises need to start working together, needs to come to some sort of agreement to see what is the solution for this, because we're not going to get better quality jobs with a shrinking economy.
Yeah, okay, so quite fearful on that front. Overall, though, the market picture, yes, the US sort of slapped off its heights for now, temporarily. The local market hasn't necessarily recovered all the losses from last year. Where do you see the general market space going?
Look, general market space has been quite resilient of late, and I mean, the all shares has been doing well this year. Resources have taken a hit with the latest round of trade talks. So we're seeing global growth situation remain problematic. And so demand for the industrial stocks and for resources is now starting to pull back a bit. We're also seeing a risk-off situation. We're seeing safe haven assets starting to increase, in particular cash. So the yen, US treasuries and so on, they're doing quite well. And so what we would want to see is that if South Africa could poise themselves economically to be in a strong situation, we are in a better situation perhaps than some other emerging markets, and so we could see inflows of capital into our market.
Yeah.
One thing I did want to mention about China, though, is just that this hit on them is essentially going to be worth about $30 billion.
Yeah.
Their market has pulled back $330 billion on that news since Wednesday last week. Since the 7th of April, they're down $900 billion. Their market's fallen 15%, which indicates that besides the tariffs, they're in a much weaker space. And so that's sort of a symptom of the global demand. And hopefully South Africa can remain resilient through that.
It's going to be a tough one, though. If the likes of China cannot survive the situation, it becomes a little tougher for the likes of South Africa as well. And already we're in dire straits. All right. Well, for now, the market is looking a little bit better, but don't know if the sustainability of that is necessarily in play. Martin Harris joining us then from IG South Africa as we unpack that market picture. As we said, unemployment rate there, 27.6%, 0.5 percentage points up, down rather, or worsening, shall we say, with that situation there. Certainly not helpful, but we'll continue to unpack the market. For now, that's where the buck stops. Back to Nzinga right after the short break. Do stay tuned.